Hello, and welcome to the 9th episode of the Market Pulse series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So before we make any progress, I would like to begin with a mic test. So if you can hear me clearly, can you type hi on the live comment section? And these will confirm that everything is working just fine. Awesome. So in today's presentation, we're going to cover something that is quite a challenge for a majority of our participants. So I've been getting these questions for years and years, and most of the people are trying to understand what the difference is between trading and investing. So in today's presentation, I hope by the end of this particular session, you'll get to understand what is the basic difference between trading and investing. We also answer a very critical question: can you do both? Can you invest as well as trade it? At the same time, what are the best assets when it comes to trading? What are the best asset classes when it comes to investing? And how do I get started? Once we get these questions done, then the session will be a success. So with this in mind, as I mentioned, once you join, kindly say hi on the live comment section. This will be good confirmation that you can hear me clearly. Hi, Teddy, and welcome to the session. Always appreciate having you on the live session. So when it comes to trading versus investing, there's quite a number of things that you'll try to understand. And once we understand these, then it will become easy to use these when making decisions about trading versus investing. So first, it's very important to understand that the main differences between trading and investing are time frames and also the amount of risk involved. So these basically cast a big difference when it comes to trading and investing. So for traders, especially if you've been trading for a while now, then you probably understand that trading is quite short-term, not as a process, but by individual trade. So in most cases, you're looking to take advantage of market volatility. So when prices are moving up, you want to be buying. When prices are moving down, you ought to be selling. And this is basically how you benefit by participating in the market when there is a volatility moving in a particular direction. On the other hand, if you're investing, then in most cases, you are doing this for a longer period of time. So if you're buying a stock today, then you'll probably reevaluate that decision 3 months, 6 months, 1 year down the line, or more than that. So investing is quite long-term, basically focuses on the long-term outcome of a position, whereas in trading, you focus on the short-term. So we know that these are different types of traders. So when it comes to trading, there are scalpers who will enter and exit the markets within a couple of seconds or even within a couple of minutes. Whereas there is day traders who will hold on to a trade for a couple of minutes, sometimes a couple of hours, but they will still close the trades within 24 hours. So on the other hand, we have other kinds of traders, such as swing and positional traders, who will hold a position for a couple of days, weeks, or even months. So the technical trader will almost always close trades within a short period of time. However, when it comes to investing, you realize that you're holding onto positions for a longer period of time. So just to give you an example, if let's say you are a trader who trades gold, or let's say on a daily basis, then you're interested with the price action that happens within a day. So if let's say today gold was bearish, then you probably participated here, selling and then buying at a lower price and making a profit. Yesterday, maybe you did not make much when the market was moving sideways. Then the other day when market was spiking all the way up, maybe you had a buy position, then you closed that trade within the period of within the day. So you realize that every day you are having to make a couple of decisions within that particular period of time. So these decisions could be buy trade on this day, no trading this day, short selling trade on this day, different asset on the other day, and so on. So you have to make a lot of these trading decisions within a short period of time. Whereas when it comes to investing, you have sufficient time to do your research and identify a strong position. And once you identify that strong position, then the rest is just pushing money into that position and waiting for price and the market to play out to give you a reward over the long term. So long-term investors will basically benefit when prices move for a period of time, whereas short-term traders will be doing too much work looking for these positions. And whenever they are profitable, they can make quite a huge margin on quite a huge return on the investment whenever they strike a profitable trade. So that's one of the key differences. So one is a long-term, and also the time in the trade. Individual trade tends to be small. And also when it comes to research, well, the longer term investor may be doing some research to identify a position that they can take for the entire year without doing any other research. Then you realize that there's less research work that is involved when it comes to trading long term or basically investing. And if you're a short-term investor, you have to be up to date with what's happening in the markets. And you have to do a lot of work, that is research, to know where the opportunities lie each and every day. So that's one of the key differences that you may encounter in investing. So as we proceed with the session, if you have any questions, comments, or additions to the presentation, they are much welcome. Just type them in the live comment section and I'll be responding to them on the go. So hello, Tony, welcome to the session. Hello, James, welcome to the session. Happy to see you guys live here. So for those who are just joining, you should know that Tony has been with me in these sessions for the last 3 years, and this is so much appreciated. So far he has developed. I hope he's very profitable right now. So let's get on with the presentation. So time frame, we have covered that. The other part I want us to focus on is risk. So trading involves risks that are much higher, or basically a higher level of risk when it's compared to investing. So this is due to the shorter time frame and greater potential for price volatility. Investors, on the other hand, are typically willing to accept a lower level of risk in exchange for the potential for long-term growth. So since as a trader, you're looking to benefit from short-term volatility, then you realize that in order to make some meaningful profit, you tend to take on a much bigger position size. So for instance, if you are a Bitcoin trader, then you will probably take up to 10x leverage, meaning that you can take a position that is 10 times bigger than your account size. So if your account size, let's say, has $1,000, you're able to buy a position that is worth $10,000. So in this case, if the market moves by a small percentage, let's say 10%, then you make a huge amount of profit despite having a small account balance. So on the other hand, when you consider the risk that you're taking, it's much, much bigger. For instance, if you take, let's say, 10x leverage, or you basically trade 10 times the size of your account, and you have $1,000 in your account, if Bitcoin drops by $1,000, then you're out. In that case, you'll be margin called. So you are taking a much bigger risk on your capital when you take on leverage and try to take advantage of short-term volatility. However, if you are a long-term investor, let's say, for example, in Bitcoin, what happens is that you buy this particular asset without leverage, and then you hold on to that asset for a long period of time. So even if price drops by 1,000, 10,000, then you will not be much affected. Mainly because you don't have leverage, so you have more muscle, hold on to that position for a longer duration of time. So investors don't usually get margin called, but traders can easily get margin called, especially when they take a much bigger risk than they had planned to. So that's one key thing to consider. If you are a long-term investor, then you might get some slow growth, but at the same time, lower level of risk, so your funds are much more secured. So the other key thing to consider is potential return. So because of the higher level of risk involved in trading, then the potential reward are also the same. So it's a high risk, high reward game, and low risk, low reward. So if you're taking a much higher risk, and if you happen to be successful, then the reward is also significantly higher. So it's easy to find a trader who is making 100% returns in a month, and way too hard for a long-term investor make 100% return even in a year. So you realize that the returns are much higher on the trader side, but also the risk is also significantly higher. However, when you consider the investing side of it, yes, you might get slow returns. For instance, the S&P 500 will basically yield around 13 to 15% per year. And this is over an average of a period of time. Let's say you invest in the S&P 500 for the next 10 years, you get an average return of, let's say, 13 to 15%. So for other assets, they have different levels of risk reward. And also, if you basically decide to trade individual stocks, you might get a higher alpha, you might get a higher return on investment. Perhaps you could even get 20, 30%, or even 50% investing per year. So as you can see, the expected returns when it comes to investing are much lower, and this can be compared to the risk, which is also significantly much lower. However, if you are a consistent trader, you can even do 10% per month, and this is massive. If you do 10% per month, it's way over 120% per year, and this is something that you can quite achieve. You have the skill, you have the edge, that is basically a trading strategy that has a winning edge. And if you trade this consistently over time, then it's something that you can literally achieve. So the potential return in trading is way much higher, but also the risk is higher. In investing is way much lower, but also the returns are also much lower. So now that being mentioned, let's look at trading versus investing strategies. So if you are an investor, it's pretty simple. You want to invest where you see value. So you basically look for businesses that have a good record of beating earnings estimates. So you want a business with a history of getting good returns over time. So if a company is experiencing some good growth, it's making some market-beating revenues, market-beating earnings, then you basically invest in that business, build a position in that business, and as the business grows, so is your investment. So it's basically a value play. So you're identifying something that has a very strong value, but the price is much lower. So you find that if a business is undervalued, and I'm talking about a stock, that is company is very solid, has a very good fundamentals going for it, and you expect the company to perform well in the next couple of years, then you buy that stock when the price is low, and then you hold on to that stock, keep on adding more money to that stock, multiplying your number of stocks, reinvesting your dividends into the stock, and then over a period of time, let's say 5, 10, 20 years, you get a very decent return from that investment. So another key area when it comes to investing, there's also what you call growth investing. So you find companies that have a much higher growth rate than the industry average. So you might find, let's say, an area such as the tech sector. You realize that the tech sector is doing well, and companies are, let's say, on average growing at, let's say, 20% per annum. So if you realize that there's a company that has a much higher growth than the industry, then you're basically doing growth investing, buy a position in that company, and you keep adding more money to that company. Then over time, you find that you have market-beating returns, or the returns that are much higher than the overall industry, or even a particular sector, or even the overall stock market. So that's one way when it comes to investing. You can do value investing, growth investing, and so on. So when it comes to trading, it's way much different. You don't focus on the fundamentals as much as a value investor does. So in trading, it's more about probability play. So you won't find a winning strategy. That is a strategy that helps you identify entries and exits. And with this strategy, every time you identify a trading opportunity, then the potential for getting a win over a loss is above 50%. That's what you call an edge. So if let's say you're winning 60% of your trades, then your edge is 10%. That's basically 50 plus 10. So if you get a strategy that has more wins than losses, then that's good for you. All you have to do is to identify such positions diligently and then keep executing those trading positions over time. And then overall, you find that you are a profitable trader. And that's as simple as mentioned. So when it comes to strategy, traders will use a couple of strategies to identify an edge. One of them that is very common is called momentum trading. Try and identify technical trading indicators, sentimental indicators, fundamental indicators that show you the momentum in the market, and then execute trades along this direction. So if you realize that the momentum is saying that the dollar is strengthening, then you look for buying position in the dollar and you get to benefit from that. So there's also what we call contrarian trading, where you look for overextended markets and trade in the opposite direction. So in this case, traders will look for weaknesses in the trend, weaknesses in the movement of the markets, overextended levels. So sometimes they use oscillators to know when markets are overbought and oversold. And once the markets, they identify that the markets are at extreme levels, then they trade in the opposite direction. So if a market is going up and it gets overbought for quite a period of time, then the contrarian trader will be looking to short that market. Your market is bearish and it gets to an overextended level, then that particular trader will be looking to buy and take advantage of the overextended level. So let's say, see if you can get an example of the same. So one of the key signals I saw in the pound USD, this was some time back, I think it was 3 months back. The market was trading on a bearish channel. Clearly, the dollar was quite strong this year against all other currencies, except the Russian ruble. So notice that this particular market was following a particular path here. However, back in September, it managed to cross through all the way down and get to this overextended level around 1.04. And then from then, you can see the contrarian traders came in and pushed the prices right back up by buying more when the prices were overextended on the lower side. So this area was considered to be overextended, and a lot of traders who bought here very benefited trading in the opposite direction. So that's one of the approaches that contrarian traders will look for in order to benefit from such a continuation. So, for instance, if you are a momentum trader, you want to benefit by following the momentum, you would know that the S&P 500 has been on a bearish trend since the beginning of the year. So going down and then up, down, up, down, up. And in the most recent swing, the market went up, hit this particular resistance before retesting it earlier this week. So market went all the way back up, got to the same level. There was a lot of rejection on this particular trend line. The market continued further downwards. So in this case, the overall momentum of the S&P 500 since the beginning of the year can be summed up with this line, saying that this is the overall trend. So knowing that this is the overall trend and this is the resistance, then it was an easy decision to make, looking for a short selling trade and targeting much lower prices. And as you can see, since bouncing from this particular resistance, there's a good chance that the S&P 500 will keep continuing along that trajectory. So that's one of the examples of how technical traders will use either momentum trading or contrarian trading to execute positions in the market. So for the longer-term trader, they may not be interested in doing as much technical analysis as we do with fundamental analysis. For them, they're trying to build a position with a longer-term goal. So what matters to them is whether they are right or wrong. If they identify the right asset that has the strongest potential of moving in one direction, then they pump even more money into that particular asset. So the other key thing is the potential return. So because of the higher level of risk involved in trading, then the reward is the same. I think I've already mentioned this, so sorry for repeating that. So the other point is fees and commissions. So since the trader is executing much more trades compared to the investor, then this particular trader will be paying more fees and commissions to their trading broker compared to the overall long-term trader. So a trader may be doing a small number of positions in a year, maybe 10, maximum 20. But then when it comes to the trader, they might be doing a lot of trades within a short period of time. Maybe in a month, they are doing 10 to 20 trades. So while the longer term trader is doing, let's say, 10 trades in a year, the trader is doing 10 to 20 trades in a month. So this means that every time they execute a trade, they pay a fee or a commission, and these can sum up to a bigger amount when you look at a longer term duration. So it's very important to know that it's much cheaper to invest, whereas in terms of fees and commissions, it's a little bit more expensive to trade actively in the markets. So on the other hand, there's what we call liquidity. Trading typically involves buying and selling high liquid assets, such as stocks, could be currencies, could be commodities such as gold and oil, and these can be easily converted to cash. So if you are a trader, you want an asset that has as much liquidity as possible, because the prices are also competitive. The spread is very small. For instance, if you're a trader who trades Euro USD, Pound USD, you know that the spread is much, much lower. So for you to turn into a profit, it takes only a couple of seconds, and you realize that your trade is now bagging some pips that you benefit from. So on the other hand, if you're a long-term investor, what you're interested in is the potential for that asset to grow in price or in value over time. So as a value play, you're not interested in the liquidity of the market. You are interested in how the asset might be performing 4, 5, 10 years from now. So in that case, you might also find yourself investing in assets that have lower liquidity. So that's a key difference that you might notice. You might find that investors also invest in real estate. Sometimes they do collectibles. So when you see Kenyan investors going for land, it's because they're able to hold on to that piece for 10, 20 years and then sell at a later date. Whereas if you're a trader, you don't see any sense in that because you need that money tomorrow to make the next trade. So the less liquid market in land is not attractive to the trader, but also more attractive to the investor who looks to sell that particular asset after a long period of time. So I hope this is making sense to you guys. So going forward, there's also the aspect of emotions. So trading requires a high degree of emotional intelligence as well as discipline, since you have to change your decisions every now and then. So you might be buying gold today, and then tomorrow, after doing your research, technical, sentimental, and fundamental analysis, you realize it's going down. So you change your mind immediately and then start short selling. Then the other day you could be short selling, the other day you could be buying, and you have to keep changing your mind every now and then. And this also involves changing your emotions or monitoring your emotions and controlling those emotions when you are making those trading decisions. So it's very important that you learn to master emotions in trading. So sometimes when it comes to trading, you may be faced with a sequence of losing positions. Sometimes you execute a trade, despite doing all your research, following your plan, the trade goes into the losses. You execute another one in Pound USD, you get a loss. You execute another one in gold, you get a loss. It's called a winning run, and a losing run, and it's normal. But then when you're losing money in the markets, it kind of messes up with your emotions. So you have to master those emotions and remove the relationship or the emotional relationship between one trade and another. So if, let's say, you just exited a Pound USD losing position today, and then you see another one in USD yen or even in the same pair, and in this case, it's still within your strategy, you should be able to like mute or remove all those emotions from the losing trade that you just had, and then execute a perfectly new trade and wait for the market to do its thing. So when you trade without those emotions, then you kind of are able to follow the process through, follow your trading strategy, and basically guarantee your own success. So it's quite a tough game when it comes to trading. For the investor, less emotion is involved. All they need to do is to build as much conviction into a particular asset as possible. And once they have that conviction, all they have to do is to do reinvestments from time to time. So for instance, if let's say you decide to buy Tesla shares today, then a month from now, if you've done your research very well and you have strong conviction that Tesla shares are going up, then all you'll be doing is buying more and more. If prices drop much lower, then you buy the dip and you keep on buying. And since you have a longer term outlook, then 4 or 5 years, 10 years down the line, the difference in price that you paid will not be as impactful to the outcome of your investment. So the other part is expertise. When it comes to expertise in trading, you need a lot of research, you need a lot of professional help and guide. So you need to really invest your time in learning how to trade. So there's a couple of things that you need to get yourself started with. One of them could be introduction to trading, get to learn introduction to Forex, stocks, indices, commodities, and so on. At the same time, once you cover these, you need to learn how to use the trading platform. You need to have some good level of skill in technical analysis. You need to know your chart patterns, your candlesticks, your candlestick patterns, entries, exits, support, resistance, waves, and so on. So once you understand and master your technical analysis, it's also important to understand your fundamental analysis. You need to know the factors that move that particular asset. So if you're trading Euro USD, you need to know what moves the Euro, what moves the US dollar. You need to understand the European Central Bank and its policies. You need to understand the Federal Reserve Bank of the US and its policies. You need to know the impact of GDP data for both economies, impact of jobs data, inflation data, and so on. So once you understand these, then it becomes easy to follow through the information and identify trading opportunities. So in addition to that, you need to understand, let's say, sentimental analysis, what other traders are doing, where they are allocating their positions, and these will give you a much stronger edge compared to any other person trading the same asset. So once you get the expertise, practice these on your demo account, move on, get to a live trading account, develop the muscle, the skill, the conviction, and also the consistency in trading these assets. So it may take some time. For some traders, it may take up to 6 months, others 1 year, others 3 years. It differs from person to person. So make sure that you have that skill, and if you turn up every day, then that skill will reward you. So when it comes to investing, you don't need as much expertise as a trader needs. So if, let's say, you want to invest, let's say for retirement income, let's say from dividends, then you can simply follow the best investors in the world or the best investment managers in the world. Look where they are allocating their assets, allocate your assets there, and over a period of time, you'll get similar returns as those professional investors with much more research than you have. So you don't have as much expertise than a trader needs. But then, once you get that expertise in trading, it will become an added advantage when you decide to start investing. So the other key thing is goals. When it comes to trading and investing, people have different goals. So if investing for the future, you might have quite a number of goals. One of them could be retirement income. A lot of investors do so. You buy particular stocks, could be commodities, indices, and you build a big position where you are looking to retire on that money. So it could be, let's say, to buy yourself a home, could be a ranch or whatever that is. And once you build to that particular level, then you'll be satisfied with the outcome. However, when it comes to traders are mostly motivated by the potential for making quick profits. So if you are a trader out there, you know very well that once you deposit money in your account, you want to make good profits and grow those profits real quick. And once you get the profits, then you can, let's say, decide to have an investment plan where some of your profits are driven towards a reinvestment, whereas others are maybe for consumption or any other purpose. So there are different goals to trading versus investing. So the other key thing is that trading can be a career. Investing is hardly a career. So investing is something that you do long term. You are not able to generate consistent income to basically honor your monthly bills. So for a trader, they might be doing this consistently, getting money and living on that income. But then when it comes to investing, the returns are much slower, and you want to realize a much bigger outcome over a period of time, not over the short term. So there's also the issue of tax implications. Trading and investing may have different tax implications depending on the jurisdiction you are at. So depending on the type of assets and also on the time frames involved. So in most cases, you realize that investors that hold onto an asset for a longer period of time will pay much lower taxes, and traders who hold onto an asset for a much smaller period of time, they tend to pay much higher taxes. So this is mostly true in the US, but in Kenya, I think it's not much of a difference. So then there's also the issue of diversification. So while the trading, as mentioned, is majorly based on probabilities, you might find yourself being profitable trading just one pair. You might be very comfortable trading Brent oil, and you focus on Brent oil, and that's your asset, and you trade that each and every day of each and every week, each and every month of each and every year. However, when it comes to investing, you can get a good number of benefits by diversifying your portfolio. One of them, you might lower the risks associated to your portfolio by having investments in different geographical locations. So you might have some assets in Kenya, others in the US, the Eurozone, Asia, and so on. So you might also diversify across different sectors. You might have some assets in the tech sector. You might have some assets in the healthcare sector, financial sector, energy sector, utility sectors, and many other sectors. So once you diversify your portfolio in that manner, then you are able to safeguard yourself from certain systemic risks that may affect particular markets. So that's one key thing to understand when it comes to investing, that diversification can be very good. But then when it comes to trading, you're not looking for diversification. You're looking to get a winning edge and trade that edge in one market that fits your trading strategy. So there's also the issue of regulation. Trading and investing may be subject to different regulations. So depending on the types of assets involved in the markets in which they are traded, for example, trading in the financial markets can be subject to stricter regulations than investing in real estate and other non-financial assets. So we know that in some asset classes, such as Bitcoin, Ethereum, there's little to no regulation. If you're trading in, let's say, Forex, trading in commodities or any other derivatives in the financial markets, then you'll be guaranteed to get protection from the Capital Markets Authority of Kenya, which licenses brokers in Kenya, such as FXPesa. So you get a lot of these happening. But then if you're investing, let's say you decide to invest in, let's say, private equity, some piece of land, there's little to no regulation. And in that case, even being conned becomes an issue. So you have to consider regulation when you're making these decisions about trading versus investing. So lastly, size of positions. Traders tend to take much smaller positions compared to investors. I find that a trader may be having a small account, say $1,000, $2,000, $5,000, that they trade each and every day, looking to make, let's say, $10, $20, $30, sometimes $50, $100. On the other hand, when you look at investors, they look to build a much bigger position. So an investor may start with the same amount, let's say $5,000, but a year down the line, they have added even more money, and they are, let's say, at $15,000, and they keep on adding to that investment, looking to benefit from the long-term growth of that investment. However, for traders, they take smaller positions in order to distribute their risk across different positions, so such that if they are in a couple of losing positions, it doesn't hurt their portfolio as much. But then if they are winning, then they keep on building that account over time. So that's one key thing to notice. And also, it's also important to know that traders are the ones that take advantage of leverage. Sometimes we call this full margin. So traders will basically take on leverage as high as 400:1 in Kenya. That's the limit that is approved by the CMA, or the Capital Markets Authority of Kenya. Be able to take a trade that is 400 times bigger than your initial investment. In this case, you basically expand your potential for risk as well as your potential for reward. So if you are successful, you make a good killing. If you are unsuccessful, then you can lose your money quickly. On the other hand, if you are a long-term investor, then leverage might not be a friend. You want to be able to weather different market swings, even if it's a recession or whatever happens. in the market between now and the next 10 or 20 years. So in that case, most investors don't take on leverage. They'll be having fully paid assets, holding onto those assets for a longer duration of time. So when it comes to types of assets, what I've seen with most traders, they'll go for more volatile assets. And these assets include gold, silver, platinum, palladium. Those are basically precious metals. They go for oil, majorly WTI or US crude oil, and also Brent oil or UK oil. They also trade volatile currencies. An example will be Euro USD, Pound USD. They'll go for USD and USD CAD, Audi USD, New Zealand USD, and USD Swiss franc. So on top of that, they also trade Bitcoin, they trade Ethereum, among other cryptocurrencies. So traders will mostly look to benefit from volatility, so they look for volatile assets. On the other hand, when it comes to investing, you'll find that investors will find less volatile assets, assets that have the potential of moving in one direction and maintaining a long-term trend. So they will mostly go for equities. Equities are basically shares of various companies around the world. So an investor might be interested in holding positions in Apple stock, could be Tesla, Facebook, Nvidia, or any other stock in the market. So besides buying stocks, investors may also buy what we call ETFs. So exchange traded funds are basically a basket of stocks combined together into one stock. So you might find an investor buying the SP 500 stock. They might be buying the Russell 2000 stock. They might be buying an ETF. This could be Cathy Wood's ARK ETFs or any other ETF out there. So they hold on to these assets for a long period of time and get to benefit from the long-term growth of these ETFs. So they also take big swing positions, especially when commodities are at much lower values. So you might find long-term investors buying a commodity. This could be gold when it's underpriced and hold on to this commodity for a long period of time. They might be buying oil or any other commodity in the market. So traders will also trade equities. They also trade stocks and daily movement of stocks. So they'll be focused on the announcements happening in stocks, such as earnings and so on. So they also be trading stock market indices, such as the S&P 500 index, the Dow Jones 30 index, the Nasdaq 100 index, and Nikkei 225 index, FTSE 700 index, and so on. So those are some of the assets that traders will trade compared to investors. So when it comes to rebalancing, a trader never really rebalances their portfolio. All they are doing is opening positions, closing, cutting the losses short, and holding on to it, have a predefined period for rebalancing. So this is the period after, let's say, 3, 6 months, 1 year, the investor sits down, reevaluates their stocks, look at how they are performing. If one asset is not doing well, then they might remove it and add another asset that will be performing better than that one. So in that case, they rebalance their portfolio to achieve optimum returns. So when it comes to psychological factors, trading and investing may involve different psychological factors. So one of them is fear, 2 is greed, 3 is confidence, and so on. So we have all been through this series of psychological factors. Sometimes you are very much afraid in trading a particular asset or in risking your money in the markets. Could be greed, you want more, you want to recover what you lost, and so on. Could be overconfidence, underconfidence, and so on. So all these psychological factors will affect you from day-to-day trading. So you have to sit back and develop a plan of monitoring your psychological position to make sure you are not falling for common psychological bias. And once you get this done, then you are able to focus on the process and hopefully become profitable by following through your trading strategy. So traders may need to manage these emotions more actively to stay focused and disciplined, while investors may have more time to think and plan their strategies. So if it's an investor, you don't have to do it today, you don't have to do it next week. You have time to reconsider, do research, and get second and third opinion before committing your money in a particular asset. So that's one of the key things to think about. So as we approach the end of the presentation, I'll be mentioning 2 more key points. One is research and analysis. Trading and investment may require different levels of research and analysis. Traders may need to stay up to date with the latest market news and trends. For instance, this week was quite crazy. We had a lot of news happening in the markets from the UK. We had inflation data, we had interest rate data, we had data affecting the economic plan for the UK and so on. So in the US, we had the CPI or the inflation data. We also had the interest rate data, same case as Swiss franc, the euro, all these happening within the same week. So we had to follow through all the news, go through the FOMC press conference, go through the ECB press conference, and in a bid to try and identify potential discrepancies in the market so that you can trade those opportunities. So as a trader, you follow through all these news. You have to keep up to date with what's happening in order to identify potential trading opportunities. As an investor, you don't have to go through all these. You can literally narrow down on one particular asset, could be 2, 3, 4, 5, and then do your research properly, team up with other traders, with other investors, and identify the best asset for your investment. So lastly, professional assistance. Trading and investment may involve different levels of professional assistance. So you will need a broker by your side, providing you with the assets that you need, market updates, news, risk management tools, and so on. You might need Rufas to be doing some market analysis for you. That's financial markets analysts. They'll basically break down the information, tell you what's happening, help you grab some of the concepts happening in the markets. And this way, you trade from an informed perspective and you can easily identify opportunities. You might also need other traders through what we call community trading. So you mingle with other traders, understand their challenges, how they are solving their challenges, their strategies, whether they're doing better than you or worse. Try to compare and contrast so that you can grow together as a team. So this is one thing that you do mostly as a trader. However, when you are just an investor, you may not need all these. You may not need a community. Yes, you'll need professional assistance to see what other professional investors are doing, but you can easily do well by yourself. So thank you very much, guys. Thank you for your time, and thank you for participating in this session. I hope it was helpful. If there's any question or comment, then I would like to respond to that right away. So, hello, Spill. Hello, Evelyn. Thanks for being here. Hello, David. Hello, Pius, and also Harrison. Thank you, guys. Thank you for your time and also your participation. I always appreciate when you guys are active in this session, asking questions, responding to the questions. It really helps the sessions go forward and create more value for everyone. So thank you very much, guys. See you on the next session. So I think there's a comment here, low maximum investment. When it comes to investment, those traditional barriers do not exist anymore. So if you're looking to start trading today or start investing today, you can literally start with $10. That's about 1,000 Kenyan shillings. So from there, you can literally buy 1 share or 2 shares. And then from there, you just build that habit of investing over time. So investing is a process where you build something over time, rather than something somewhere where you pump a lump sum amount of money and then wait for it to grow. So think of it as a process where you build onto something. So hi, I would like to join trading. Thank you. I'll send you the link to get started. Basically register an account. So use that link, register for an account, and also visit the channel, that is the FX Pesa channel. Go through the Novice to Pro series. It's one of the most popular series that I've done to help you transition from a beginner trader to a pro level trader. Once you get that covered, then you're good to go. So how can I read the news? We basically follow the news from different websites. So if you go to the Novice to Pro series, I think it is the last episode where we cover the news. So these will help you understand the news to focus on and where to get the news. So with the formation of BRICS, how will it affect the market? I think we'll be looking at a whole new dynamic of how oil is traded and distributed around the world. So you might see new dynamics in trading, especially for Brent oil and US oil. So we might be seeing a lot of volatility in that. How it turns out, I don't know. So I'm yet to find out as we see more developments in the story of the BRICS. So which platform is the best to start investment? FX Pesa, bit.fxpesa.com/Rufas. I already shared the link. Just register. We have investment products. So which is the best platform for trading stocks? FX Pesa. I've already shared the link. Just check the comment section. You'll see that. So thank you, Ken. Thank you, everyone. See you on the next session.